This is Barry Zalma speaking for Claim School Incorporated's blog, Zalma on Insurance. Today we're going to speak about why it is necessary for an insurer to pay the limits as written and why it is prudent for an insured to read the policy before the insured sues an insurer. The insured, in this case, sued its insurer for what it believed was the limit of liability of its policy for damage to property by a fire. The insurer defended based on the fact that as an excess policy in one of multiple layers of insurance coverage, it was only obligated to pay that proportion of the losses described in the policy. The insured sued, and the United States District Court for the Eastern District of Washington resolved the dispute by reading the full policy in a case called Oregon Potato Company versus Kinsale Insurance Company, a May 5, 2023 decision of the United States District Court. In a first-party property insurance excess coverage dispute, the USDC was faced with competing motions for summary judgment. Plaintiff Oregon Potato Company, or OPC, sued Kinsale Insurance Company for declaratory judgment, breach of contract, insurance bad faith, violation of Washington's Unfair Claims Settlement Practices Act, and reservation to assert claims for violation of Washington's Insurance Fair Conduct Act. OPC is a Washington corporation headquartered in Pasco, Washington, that processes vegetable products and has a facility in Wharton, Washington. On January 21, 2021, a fire destroyed or damaged OPC property in Wharton. Before the fire, OPC had purchased first-party property insurance covering the properties written in 3 layers, with the last insurer, Kinsale, taking 20% over the second excess layer for $25 million to $50 million for the shares shown in their respective parentheses. Kinsale expresses liability as $5 million, part of $25 million, excess of $25 million per occurrence. Kinsale's policy contains the following insuring agreement. Quote, "The company will indemnify the insured for our share, as shown in Item 1 of the declarations page of the policy, of the ultimate net loss caused by the direct physical loss or damage to covered property in excess of the primary and underlying excess insurance as shown in the schedule of underlying insurance of this policy occurring during the policy period. This agreement is subject to the following terms, conditions, and any endorsements to the policy." In that vein, Kinsale's policy defines ultimate net loss as follows. Quote, "Ultimate net loss shall mean the actual loss sustained by the insured as a direct physical result of the perils insured against by the policies of the primary and or underlying excess insurance, limited by A, any sublimit contained within this policy or policies of the primary and or underlying excess insurers, and B, making deductions for any salvage and recoveries from any source other than this policy and the policies of the primary or underlying excess insurers." Close quote. The first sublocation listed on the statement of values, shown in paragraph 10 of the policy, was severely damaged. Kinsale initially viewed OPC's loss as a complete loss to our layer capacity and set reserves at its full $5 million limit. Kinsale does not dispute that this was a preliminary determination, but contends that it was subsequently superseded by a more accurate determination of a lower loss reserve after investigation and evaluation proceeded. OPC sent an Insurance Fair Conduct Act notice to Kinsale asking it to pay the full $5 million limit. Kinsale responded that its policy unambiguously provides only limited liability for Location 1 to the $25,100,000 stated value and that its limit of liability is not $5 million, but instead is 20% of every dollar of loss above $25 million. OPC contended it is currently entitled to payment of the remaining balance of Kinsale's $5 million policy limit, and Kinsale is contending that it has paid all sums according to proofs of loss submitted to date. The occurrence limit of liability endorsement, the OLI, is a modification to underlying policy and sets the upper limits of Kinsale's liability. The OLI is read in connection with the rest of the policy as, quote, all other terms and conditions of the policy remain unchanged, close quote. The underlying policy states that Kinsale will indemnify, quote, for our share of the ultimate net loss in excess of the primary and underlying excess insurance as shown in the schedule of underlying insurance of this policy. Taken together, the language of Kinsale's policy is not ambiguous. Kinsale's insurance policy provides excess coverage, which when triggered is for their, quote, share, close quote, that is $5 million out of $25 million, or 20%. Kinsale's proportional share liability does not automatically entitle OPC to $5 million under the OLI. To read otherwise would entitle OPC to overlapping, not excess coverage. It was only required to pay 20% of the amount owed by its share of the total loss. Therefore, summary judgment in Kinsale's favor was appropriate. This video was adapted from my blog, Zelma on Insurance, which is available free to anyone who clicks on the URL zelma.com/blog. It is also available on YouTube and on rumble.com, and you can subscribe to the blog, to the videos on Rumble or YouTube or both. They're all free. And if you found the blog and the video to be of interest to you and useful, please tell your friends and colleagues so that they can also subscribe. And if you wish further information or details about insurance, insurance law, and insurance claims, consider subscribing to my Locals community and my Substack publication for a very small fee. Thank you for your attention.